Passive income, earning money wildly, it's everyone's dream. And there are only three ways to have it: the bank interest, the dividends from shares, and rental income from investment properties. These are all genuine sources, but today I would like to talk about why some form of passive income aren't ideal for wealth building, and why you should consider property investment as part of your wealth building strategy. Hi, my name is Eric Lee. I'm a chartered accountant with more than 15 years of experience and currently hold a real estate agent license, providing trustworthy information about property investment and tax in Australia. So, if you don't want to miss out future updates, please hit that subscribe button and stay tuned. Bank interest and dividends, they are often marketed as ultimate set and forget options. And technically they are. You invest your money and in return, you get small stream of income. But here is the problem. Unless you already have a massive amount of money saved, the income is not really life-changing. Let's say you've got $200,000 and at 4% interest, that's $8,000 a year. Dividends? Maybe $10,000 if your portfolio includes some high dividend shares. Not exactly enough to change your lifestyle. Therefore, in order to get enough income for your retirement, the focus should be on how you can build your wealth quicker and safer. Otherwise, you are stuck in the 9-to-5 treadmill life. To build wealth faster, you only need to understand two concepts: leverage and compounding effect. This table shows the difference between two scenarios: depositing $100,000 in a bank at 5% interest rate versus using the same $100,000 as a 20% deposit to buy a $500,000 property. As you can see, the difference is massive after 20 years. Even after deducting that $400,000 loan, the difference is about $600,000. Yes, you may incur some losses early on, but the long-term gain is still substantial. Why? Because property investment allows you to benefit from both compounding and leverage. And there's no other asset class where you can borrow up to 80%. That's why property stands out in the game, as it offers unmatched leverage. Also, as property prices rise, rental income increases as well, because the rent is typically a percentage of your property value. Your debt, on the other hand, stays the same or reduces over time. And this means even if you started out as negatively geared, your property will be likely become positively geared, and from that point, all capital gains are yours. That's when real wealth building begins. Share investment is a bit different. Unlike a bank deposit, shares can offer exceptionally high returns, sometimes even outperforming other assets, including properties. But they come with higher risks, and you can't borrow as much against shares as you can with properties. Even if you can, margin loan interest rates are usually much higher due to the increased risks. I'm not saying that you should go all in on properties, but if you are serious about building wealth within the retirement timeline, properties should be at least be part of your portfolio. Unlike the share markets, the Australian property market is historically more stable in the long term, and banks know it. That's why they are willing to lend 80% or even more for property purchases. And we all know banks hate risks the most and rarely lose money. So if you're planning to invest in property or you've already started, your next step is to build solid foundations and strategies to maximize returns and reduce tax and unnecessary costs. If you need help, feel free to reach out using the contact details in the description below. Thanks for watching, and I will see you in the next video. Bye for now.